AWS is growing at a pace we haven't seen since 2022, re-accelerating to 20.2% year over year. That's Andy Jassy basically announcing that Amazon just hit the nitrous button on their cloud business. And honestly, that one sentence tells you everything you need to know about where this company is placing its bets right now. Amazon just reported $180.2 billion in revenue for Q3, which is a 13% jump. And on the surface, that looks pretty solid. But when you start peeling back the layers on these numbers, what you find is way more interesting than just another strong quarter from Jeff Bezos's old stomping grounds. What we're actually seeing here is Amazon in the middle of this massive transformation where they're spending ungodly amounts of money on AI infrastructure while their traditional retail margins are getting squeezed. And that tension between growth and profitability, that's the real story nobody's talking about enough. Let's talk about AWS first, because that's where the action is. They pulled in $33 billion for the quarter, growing at 20% year over year. That re-acceleration is huge. They'd been stuck in the high teens for a while, and now they're breaking through that ceiling. And it's pretty clear why. AI demand is absolutely exploding. Andy mentioned they added 3.8 gigawatts of power capacity in the past 12 months, which is more than any other cloud provider. For context, a gigawatt is enough power to run about 750,000 homes. So we're talking about infrastructure on a scale that's honestly hard to wrap your head around. Data centers aren't just big warehouses with servers anymore. They're basically power plants with computers attached. The cooling systems alone are engineering marvels because these AI chips generate insane amounts of heat when they're training models or processing inference requests. Amazon's betting that if you want to run serious AI workloads, the kind that companies are willing to pay premium prices for, you need world-class infrastructure, and they're building it faster than anyone else. Their custom Trainium 2 chips are fully subscribed and became a multi-billion-dollar business that grew 150% quarter over quarter. That's not a typo. 150% growth for a chip business that was already generating billions. They're also launching these massive compute clusters like Project Rainier with nearly 500,000 Trainium 2 chips specifically for Anthropic's Claude models. And here's where it gets really interesting. Amazon invested in Anthropic and made $9.5 billion in unrealized gains this quarter from that investment. That's actually what drove most of their net income growth. Without that gain, the profitability picture looks pretty different. Speaking of profitability, this is where things get messy. Operating income was $17.4 billion, which sounds great until you realize that's basically flat compared to last year. And actually, it's worse than flat when you account for growth. Their operating margin dropped from 11.0% down to 9.7%. Now, there were some one-time charges in there, a $2.5 billion FTC settlement and $1.8 billion in severance costs from layoffs. Without those charges, operating income would have been $21.7 billion, which is much better. But even then, margins are compressing across every segment. North America operating margin fell from 5.9% to 4.5%. International dropped from 3.6% to 2.9%. Even AWS, which has been their cash cow, saw margins compress from 38.1% down to 34.6%. And the culprit is obvious when you look at their expense breakdown. Technology and infrastructure costs jumped 30% year over year. That's where all the AI spending is showing up. They spent $87.1 billion on property and equipment just in quarter three, which is a 78% increase year over year. On a trailing 12-month basis, their capital expenditures hit $115.9 billion. That's an absolutely staggering amount of money to be deploying into physical assets, and it's causing their free cash flow to crater, down 69% to just $14.8 billion. They're generating $130.7 billion in operating cash flow, which is fantastic, but then they're turning around and spending almost all of it on infrastructure. This is the classic innovator's dilemma playing out in real time. Do you optimize for today's margins, or do you invest aggressively for tomorrow's market position? What's interesting is that the retail side of the business is still performing well, just not spectacularly. Online stores grew 10%, third-party seller services up 12%, and advertising, which has become a genuinely important revenue stream for them, grew 24% to $17.7 billion. That advertising number deserves more attention than it gets because it's almost pure profit compared to the thin margins on retail. When brands pay Amazon to promote their products in search results or on product pages, there's basically no cost of goods sold. It's just software serving ads. They're also making progress on the logistics side with faster delivery speeds and expanding same-day grocery delivery to over 2,300 communities by end of year. But here's the thing. All of that infrastructure investment in fulfillment centers and delivery networks and last-mile logistics, it shows up as declining margins in the North America segment. They're playing a long game where they're willing to sacrifice short-term profitability to build an unassailable competitive moat. Nobody else can match Amazon's combination of selection, price, and speed. The question is whether the market will be patient enough to let them execute on that vision, especially with margins compressing. And the other wild card here is all the other stuff Amazon is doing that doesn't neatly fit into online retail or cloud computing. They've got Zoox launching autonomous robo-taxis in Las Vegas. They're expanding Project Kuiper satellite internet with 150 plus satellites in orbit. Alexa Plus is getting rebuilt with AI and seeing engagement rates that are 2 to 4 times higher than the original version. And Prime Video is becoming a legitimate streaming player with sports rights and original content. Thursday Night Football is averaging 15.3 million viewers, which is the best for TNF in a decade. They just launched NBA coverage. And all of this content creates this flywheel where Prime membership becomes more valuable, which drives more retail purchases, which generates more advertising revenue, which funds more content investments. But none of these businesses are showing up as separate line items in the financials, so it's hard to know which ones are actually working and which ones are just expensive experiments. What we do know is that between all the AI infrastructure, the autonomous vehicles, the satellite internet, the streaming content, and everything else, Amazon is spending money in more directions simultaneously than basically any other company on the planet. Look, here's where I land on all this. Amazon is in this fascinating position where they're generating enormous amounts of revenue and cash flow, but they're choosing to reinvest almost all of it back into the business. That $115.9 billion in CapEx isn't being spent recklessly. They're building data centers because they have actual customer demand represented by that AWS backlog and growth trajectory. They're not speculating. They're responding to real needs from enterprise customers who are saying, we need AI compute and we need it now. But the trade-off is visible in the financials. Margins are compressing, free cash flow's way down, and if you strip out that $9.5 billion Anthropic gain, the net income story looks a lot less impressive. The North America segment in particular is concerning because operating income actually declined 15% year over year. That's their core business, their home market, and it's going backwards on profitability even as revenue grows. At some point, they need to demonstrate that all this infrastructure investment will actually translate into sustainable margin expansion. Right now, we're in the spend to win phase, and the market seems fine with it, but that won't last forever. The Q4 guidance calls for $206 to $213 billion in revenue and $21 to $26 billion in operating income, which suggests they expect margins to recover a bit during the holiday quarter. We'll see if that materializes. This isn't financial advice, obviously. I'm just walking through what jumped out at me from these numbers based on my own research. Every investment comes with risks, and with Amazon specifically, you're betting that their massive infrastructure spending will pay off over time rather than just destroying shareholder value. Do your own research before making any decisions on this one. Drop a comment and let me know what stock you want me to break down next. Always looking for interesting companies to analyze.